Don't focus on what it is. Focus on what it does. In this episode, I'm going to advise you to not let a life insurance policy lapse if you no longer want or need it. Possibly sell it. Otherwise, you may be missing out on tens of thousands, maybe hundreds of thousands of dollars. I will give you some examples. So, I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 48 years, doing what? Helping people in America, in particular, optimize their financial assets, minimize taxes, and empower what I call their authentic wealth in all three dimensions. Hence, the name of this channel is Three-Dimensional Wealth. It's like a three-legged stool. We're focusing right now on the financial dimension in this episode. Now, a lot of people who have subscribed to my channel, and if you have not done so, it's free. And when you do, click on that little bell, and because then you'll be notified every time I post a new educational video, which I do almost on a daily basis, okay? But stay with me to the end because I want to gift you a copy of my most recent best-selling 300-page book called The Laser Fund. Now, if you watch very many episodes, you'll quickly realize that one of my favorite financial instruments for 48 years as a financial strategist, to allow people to accumulate their money tax-free and then be able to access that money anytime, totally income tax-free. And at the end of the day, when they finally pass away, anything left behind in that account will blossom, maybe even double or triple and transfer income tax-free, is a Max Funded IUL, Indexed Universal Life Insurance contract that's structured correctly and funded properly. What do I mean? You are taking the least amount of insurance that the IRS will let you get away with, so you're using it as a living benefit, hence the name life insurance. Most insurance agents sell life insurance as death insurance, only to be used when you die. No, E.F. Hutton, who is the brainchild behind the emergence of universal life clear back in 1980, basically said, we need to be using this for the tax-free living benefits. And if you want that as your primary objective, to be able to generate on every $1 million, maybe a 10% payout, $100,000 a year of tax-free income without depleting principal, starting at age 60 and lasting if you live to be 120. Yeah. Is a Max Funded IUL policy. I've helped thousands of people do this. And so you're taking the least amount of insurance that the IRS will let you get away with. These are in three sections of the Internal Revenue Code that have been around for over 108 years as of the recording of this episode. Sections 72E, 7702, and 101A. 72E says money inside of an insurance policy will grow tax-free. 7702 says you can access the money without triggering income tax if you do it the smart way. And then Section 101A says at the end of the day, when you die, anything left in there will blossom and transfer income tax free. Meaning if I died in an accident tomorrow, every $1 million I might have in IUL policies would blossom to probably about double that, $2 million, and transfer income tax free to my beneficiaries. So it's the only vehicle in the Internal Revenue Code that does that. But in order to make sure that your money grows tax-free and you can access it tax-free, you have to comply with three tax citations, and they are acronyms: TEFRA, DEFRA, and TAMRA. Basically, TEFRA and DEFRA dictates the minimum amount of life insurance protection that has to be attached to the account based upon your age and your gender and your health, so that the money grows tax-free. It doesn't move out of the tax-free umbrella under the definition of tax-free life insurance in the Internal Revenue Code. If you violate TEFRA and DEFRA, it moves over to the taxable investment section of the code, okay? TAMRA says you have to spread it out, the funding over usually about 4 or 5 payments. And so this all happened in the 1980s. So in a nutshell, most people would come to me And they didn't necessarily want or need more death benefit, even though they didn't realize they probably could use it. They came because they wanted to optimize assets, minimize taxes, and have alternatives to IRAs, 401ks, working capital for business, and so forth. Because when you really compare it, nothing else comes close to passing the liquidity, safety, and rate of return test with flying colors like Max Funded IUL, and it actually blossoms when you die. So many times I would hold up an image of a box of baking soda in front of audiences. And I would say, what are some uses for baking soda? And usually the women in the audience would speak out first and say, well, you can soak in the tub with that. It takes the odor out of the refrigerator. It takes the pop out of a pot of beans and so forth. And the man would go, oh, I clean my battery terminals with that stuff. And then somebody finally goes, oh, it's good for baking. Yeah, the obvious is baking soda. Okay. That's what life insurance is. The obvious thing is it's for life. Most people talk about all kinds of other things that it's used for, but my point is don't focus on what it is, focus on what it does. Now, it's like a financial Swiss Army knife is what I compare it to, because when you use a max-funded indexed universal life policy, it accumulates money tax-free. You can take out money tax-free throughout your whole life. It doesn't trigger penalties before age 59 and a half and all those strings attached to IRAs and 401ks. At the end of the day, it blossoms and transfers tax-free. Nothing else does that. And so you can use it for retirement. It knocks the socks off of IRAs and 401ks or even Roths. I've never owned any of those. Why would I? Because this outperforms and is far better than those. But not only retirement, but business owners use Max Funded IUL as working capital for their business. Real estate investors use it as working capital for their real estate management. It works as an ideal emergency fund instead of having money in a bank or credit union. Okay. College funding for kids, or grandkids, it knocks the socks off of a 529 plan. Pension maximization for school teachers, where you can take the difference between the no survivor benefit, let's say $5,000 a month as a retiring school teacher, and the $4,000 they were going to reduce it down to if you wanted to provide a survivor benefit to your spouse. Just take that $1,000 and put it into an IUL policy, and you will have way more benefits and flexibility than buying the most expensive life insurance policy you'll ever buy from the state where you taught school. There's all kinds of uses, estate planning and so forth. Now, the point of this episode is sometimes we get to a point because of whatever happens, circumstances, what have you, that people, they deplete their assets, they have something happen in their life, and they have a life insurance policy. Now, it doesn't have to be a Max Funded IUL. It can be a term life insurance policy. It can be any kind of, whole life insurance. And they get to a point where they no longer want it, or they don't feel like they can afford it. That they're putting money into this losing proposition. And so this happens, and it's just part of life. And so people go, you know what? I really don't care about leaving behind a tax-free death benefit, and this is putting a crimp in my cash flow. And so they're just going to let it lapse. And I go, hold on, hold on. No, this is an asset. And they go, what? No, it isn't. It's a liability. I'm having to keep paying money into this thing, and I'm not going to be around. And I go, no, listen to me. There is a secondary market. It's called the life settlement market. And sometimes in the life settlement market, you actually have insurance companies that are the biggest investors. And they go, what are you talking about? See, your life insurance is an asset. So let's say you have a $1 million policy. And, you're having to pay, $3,000, $4,000, $5,000, $6,000 a month into it because now you're in your 80s. And you're going, you know what? This is just draining my resources, so I'm just going to let it go. Well, before you do that, okay, you can shop that life insurance policy on the life settlement market. Now, there's 20 or 30 different life settlement companies, but there's about 3 big ones, okay? And so whenever I do this for a client, I fill out the paperwork and I get the signature from the owner and the insured. and they're going to shop the life insurance to see if anybody would buy it. Now, why would an investor or another insurance company want to buy your $1 million policy? Because they know the math. They're looking at what it does. If they take over that policy and they need to put in $3,000 a month or $5,000 a month, they do the math. $5,000 a month is $60,000 a year. $60,000 a year would have to earn what interest rate to grow to $1 million, especially tax-free? How many years would that take? And they calculate how many years would that premium take to grow to $1 million, especially after tax. And they back into it and they go, okay, 8 years, 11 years, 12 years, 15 years. And then what do? They take your application and they calculate your LE. That's your life expectancy. So they submit it to, they get your doctor's records and so forth, and they will calculate to the month. This person has a life expectancy of 97 months or 63 months or 114 months. They calculate it to the month. Now, you can die sooner, you can live longer, but they will calculate your life expectancy and they will do the math. And if the money that they feel that they're going to have to put into this policy to keep it going until you finally check out would give them a great rate of return, better than most investments would, they will offer you a lump sum of whatever that differential is. And it could be $50,000, $100,000. It could be somewhere between 5% up to 25, 27, 28% of the death benefit. Yep. So instead of just letting it go and getting zip, I have had clients. One had a little over $3 million of life insurance and no longer could afford it. And we were able to sell that $3 million policy for $900,000 cash instead of getting nothing. Had another policy for $400,000 and we were able to get $70,000. Another policy, $1 million. We were just going to let go. She couldn't afford it anymore, and she's getting $55,000, but $55,000 is better than nothing. Now, these are big boys and girls. The company's buying these. They've already done the math. They know that they will be the owner and the beneficiary of that policy from that point forward. And at some day when that person dies, they get the lump sum of money tax-free, but they've already done the calculation. So don't just say, oh, we're just going to let it go without at least shopping it on the life settlement market to see if you can get $50,000, $100,000, somewhere between maybe 5% up to 25% of the death benefit in a lump sum. And usually that lump sum is going to be less than what you've paid in. And so it's all tax-free. You don't have to pay tax when you get that money. Now, I wish I could go into more detail, but if this is intriguing you, you can learn about Max Funded insurance contracts. I'll gift you a copy of my book, The Laser Fund. You go to laserfund.com. You contribute a nominal amount to the shipping and handling. I'll cover the rest of that, and I'll fire out a copy of this 300-page book to you if you want to own a Max Funded insurance policy. But if you think you or someone you know may want to sell their insurance policy because they no longer think they want it or can afford it, get hold of me through the resources, through my channel, so that I can help you shop that policy and possibly get you 5, 10, 25% of the death benefit in one lump sum selling the policy before you just let it go, because it's an asset. The message is, don't focus on just what it is. Focus on what it does. It could be a good investment for somebody else who has the money to keep paying the premiums, because they will do the math. Does that make sense? This is to you and your brighter future.